Long term is how much of this do we bring into the US? And is there even an opportunity to bring this into the US? Do we have the skills? Do we have the manufacturing facilities to actually build this stuff? And that's much more long term. But I think most of these hardware companies, especially the ones I'm seeing in Silicon Valley that are innovative, are not thinking long term right now. They can only think short term and have that war room.
One of the things that I personally love about One Rental at a Time, and frankly, hopefully you appreciate, is we bring on a wide range of individuals with a very diverse background. This morning, we're bringing on the CEO of Hemlane, Dana Dunford, and we're actually going to talk about what the heck are CEOs supposed to do in this ever-changing environment. Now, as a SaaS company, maybe the tariffs aren't directly impacted, again, very North America-centric, but she has lots of friends in the Valley, and she understands what CEOs are going through, and I'm sure it is not fun. Dana, what's going on in CEO land? How are they handling this ever-changing environment?
Yeah, I think it's a great question, Michael, because before I was a CEO, I didn't know just how important my finance background was. Of constantly, and I would encourage anyone listening to this, if you do not understand balance sheet, cash flow statement, and profit and loss, like income, your number one goal this weekend is to learn that. And if you can do that, I truly believe you can weather any storm by basically planning significantly upfront what needs to happen in a crisis situation. I also will, before I go into what's happening today and what a CEO can do, I also just want to say that some of the best decisions we've made have always been in crisis situations. It's made us a stronger company. It's made us a better company. And so if your company is going through it, think of this as an opportunity, not as a downfall. I have a lot of friends in Silicon Valley. I actually part of my life was actually in hardware, which I think is most impacted, manufacturing hardware. And I worked at a company called Nest, which does home technology, got me passionate about remote management, transparency into your home, all of that, which, was like, okay, why aren't our rentals more transparent? Same sort of thing. Right. But with that, hardware is freaking hard. Manufacturing is really hard, and inventory management is very hard. And the reason I bring that up is most of my friends running hardware companies or manufacturing companies have all had to deal with inventory management. And that is really challenging. Like for us, if we need to push new code, we can push it overnight, super easy, all the customers get access. But when you have hardware and you need to change something, you have your inventory to manage of, we need to get that out the door. If there's a bug or something, all that inventory is destroyed. And so a lot of them have already had struggles with their company. Matt, who was the founder of Nest, I remember one of the first things he said to me on my first day was, if you start a company, Dana, don't start a hardware company. He said software is much easier. And so I feel for anyone who has inventory, anyone who's in manufacturing, anyone who is in the hardware space, I feel for them because they are most likely importing goods from somewhere else. So the question is, how are they weathering the storm, and what are they seeing? Well, the first thing I would say with it is there's an increase in prices and a decision they have to make. Do we cut our margins, which for most hardware companies and startups are usually actually negative when you get started as a hardware company? Do we do that, or and go into our own margins, or do we increase prices? That's the short-term decision they have to make. Long-term is how much of this do we bring into the US, and is there even an opportunity to bring this into the US? Do we have the skills? Do we have the manufacturing facilities to actually build this stuff? And that's much more long-term. But I think most of these hardware companies, especially the ones I'm seeing in Silicon Valley that are innovative are not thinking long term right now. They can only think short term and have that war room.
Yeah, I think there's so much in that. When I think about a CEO, again, I was in hardware. Part of my time was working at HP, obviously very much a hardware on the software side, but we had lots of crossover. I can only imagine not only the inventory as you talk about, which a lot of people will hear as finished goods.
Mhm.
The supply chains are so so tied together, and obviously, since probably the 80s, certainly the 90s, the just in time inventory
Yeah.
has just skyrocketed, which we really saw take a beating in the pandemic as inventories timelines got all out of whack. A lot of folks have been run by CFOs who really look as inventory or work in progress
Mhm.
as detrimental to the balance sheet. It kind of skews the numbers, right? So
Mhm.
there's been a lot of focus on how tight, how low we can keep that work in process, and it's going to be painful because, again, I think you're right. I think in the short term, and if we define the short term, let's call it a year,
Yep.
their only options are really eat or pass on the hike. I mean,
Yep.
that's all. Even in the best case, if you were going to secondarily source it, find a new vendor in a lower tariff or perhaps no tariff country, that's not an overnight thing. You've got to see test runs. You've got to do this. You've got to do, I mean, there's a process for that. So that's midterm. Call that 9 months to 18 months. And then you're absolutely right. When you're in the hardware space, one of the things you will undoubtedly think about is, okay, what would it cost to build a factory ground up? Because there's not a lot of these factories around. Any of the factories that are around and shuttered aren't set up for robotics and the specifics of, tech, hardware tech. So you're really doing ground up development. Maybe there's a shell somewhere you could build around, but again, maybe not. That's got to be 2 to 4 years away. And to your point, a huge investment. Is that 10 billion? Is it 20 billion? I
Yeah.
mean, damn, these are some big numbers.
And then the thing I would say about it, and I couldn't agree more with that, is that there's one thing I learned in business school, and it was don't run out of cash.
Yeah, I love that you brought up the cash flow statement. That is, in my opinion, the most important financial statement, but nobody ever talks about it. I'm so glad you highlighted that one because that's you know what people don't realize, you can go broke being profitable. You
Yes.
can,
Yeah.
yeah, the cash runs out, you're done.
Yeah, exactly. And so the thing that I learned about this, like don't run out of cash, is if I were running a hardware company or anything in manufacturing, clothing, whatever it is, I would actually cut deep.
Mm-hmm.
I would literally be having whatever financial analyst I have going through and doubling if I say this is how much we're burning or this is, our expenses, I would say, how do I bring this down to an uncomfortable level?
Yeah.
Because you can never do two cuts within a company. You
Yes.
can only do one. If you do one and then you go back and say, wait, we need to cut more, it really hurts morale. It really does. So
Yeah.
you have to cut once, make it hurt so badly that this will never happen again. And the company is focused on the future and growing.
Love it.
And if I don't know how this is going to impact my business, but I know it's going to be negative, because when prices go up, fewer customers are purchasing. It's just basic economics 101. If I am cutting my own margins, I have less cash, more burn. And so, from that perspective, if I were in hardware, I would have to be making tough decisions right now. And I feel for everyone in hardware, everyone in manufacturing right now, bringing goods and services into the US, even if they're selling them on a SaaS platform. I
Yeah.
feel bad for anyone in that space because of it's going to be hard and they're going to have to make
Yeah.
really tough decisions in the short term.
I've seen several CEOs on X or Twitter kind of basically beg for a reprieve on these tariffs. They're like, hey, I'm glad Apple got theirs, but what about us? And there's several clothing lines that import stuff from foreign countries, China, Vietnam, and others, that are basically saying, I'm going to have to lay everybody off and go broke. The numbers just don't pencil.
Yeah. Yeah.
And And again, if you think about Amazon for a minute, I've heard some crazy numbers like 60 or 65% of the stuff that's sold on Amazon is by individual stores, right? Amazon's the distributor or maybe the warehouse for the products. And again, if these people are relying on, again, foreign made products, they're out of business.
Yep.
This really could lead to a big bankruptcy cycle. It
Hmm.
could lead to a lot of shutdowns. And frankly, I think one of the outcomes of this could be, to your point, lots of deep layoffs. Even if the company
Hmm.
skirts by closure, they probably have to get super tight and,
Yeah.
to your point, uncomfortable just to survive. So we
Yep.
could see layoffs in small businesses skyrocket in a couple of months, maybe a couple of weeks.
Yep. I definitely agree. I think they're all in war rooms, or hopefully they all are. They should be in war rooms talking
Amen.
about the future and how to get through it on the short term. Because again, once you run out of cash, you run out of control and the company does not survive.
Yeah, cash is the oxygen. It's the blood flow, and if you don't have it, again, it doesn't matter if you're profitable. You could be profitable and growing. If you have no cash, you're done.
Yep.
So I love the highlighting of the cash flow statement. The other thing, I think there's two other things that I think are hitting CEOs' radar. One private and public, and then obviously one very much public companies. We'll get to that one last. I actually see, Dana, a very good scenario where, as the dominoes fall, we are actually going to see goods deflation, not disinflation, not
Yeah.
inflation, deflation. I think one of the things that people don't realize is going on is the consumers have had enough. They are fed the F up,
Hmm.
and you are about to see demand destruction on a scale that probably will revival what I remember from the dot-com era, right? When that whole thing blew up, the Silicon Valley just stopped spending. Housing, I mean, it was just bad. So I
Yeah.
think one of the outcomes of this, probably 90 days away, if this is still a problem, is you are going to see a consumer revolt, which will actually lead to more inventory, will lead to sales and
Yeah.
discounting, and quite possibly really true deflation, which the Fed does not want. But
Yep.
deflation could be the outcome of this.
Yep. Yep. I couldn't agree more. And I'd
Oh
love that.
no, I was hoping you were telling me I was wrong.
No, I actually, I think there is, but you know what? The other thing is that I think we can talk about recessions all day long as well, but I think this was imminent and coming, and everything that you've just mentioned, this only adds to
Yes.
the negative storm that is going to hit us.
Yeah. So again, folks, watch out for deflation, probably after the summer, maybe late summer. But again, I think what you're going to have as a consumer is, if companies, which many will try to raise prices, they're going to see a very quick feedback loop where demand dries up, their inventory builds, and then their only option, as we've seen throughout history, is discount, 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 which again will drive some people out of business, more bankruptcies, more job loss, more things of that
Mhm.
nature. Well, now let's get to public companies. I do think there's one thing at the public level that is certainly more obvious. I'm sure it happens at private companies as well, but public companies have to do this song and dance in front of analysts about every 90 days. And I could not imagine being a CEO in this environment. I thought United Airlines did something pretty creative. I think many companies will just refuse to give a forecast. But I don't know if you saw it, but United Airlines basically said, hey, here's a blue pill if we don't have a recession, and here's a red pill if we have a recession, and actually gave two guides, which I thought was kind of
Yeah.
creative. I never saw a company do that before. Shout out United Airlines for being creative. So what do you think CEOs do? Because one of their jobs is to tell the world what's coming.
Yeah. I think that it's hard to, as always, as a CEO, to understand everything going on. And to some extent, I've been in finance. I actually was on Apple's worldwide financial planning and analysis team, and my job was to help put together the forecast for the earnings call every single quarter.
Yeah.
And I think with it, one of the things that I've learned is it's a really good exercise to go through, because you sleep a lot better at night
Mm-hmm.
knowing, hey, I've looked at everything, I've gone through all the details, I've gone through what happens if this happens or that happens, like United red and blue pill.
Mm-hmm.
I think it's a really good exercise. I also think that businesses, and maybe public companies are slightly different because I think that there's slightly more stable in how things operate. But what I've always found with businesses is so many variables change. And what your job really is to say, here's my best guess on this forecast, but here's the 500 variables that go into it. And any tweak in any of them can change things. Expenses are so easy to control,
Mm-hmm.
so easy to forecast, always right on top of that. Revenue is the interesting one because it's always been in months where I'm like, oh, February is going to be a terrible month. No tenants are moving and this and that. It turns out to be a great month. And it's something that just happened, whether it is going to one rental at a time or something like that. And so I've always found that it's really hard to predict a lot of the future. But what you do need to do as much as possible is have an accurate pulse on all of their variables and what could change and what is your best estimate. And I do like having multiple of them. And I like extreme cases. What happens if things are terrible? What happens if things are great? And I think if you think in extremes, you'll get to the middle, but also know how to react based on what's happening with your business every week.
Yeah, I think a lot of the world is in extremes today. And it's funny. My whole investment strategy while building the portfolio was, what's the worst case scenario for this asset, this particular asset? And if I
Yeah.
could live with it, we move forward. Because if you can control the downside, the upside takes care of itself.
Yep.
The last thing when I think about CEOs, and again, you've mentioned war rooms a couple of times, which I'm sure they are in. At some point, right? Initially, it's going to be very much, how do we protect ourselves? How do we protect our cash? Is there any knobs that we can turn to make this slightly better? But at some point, to your first point, actually, before we even talked about it, at some point, CEOs are going to start making moves, whether that be acquisitions or investments or going after new markets, right? Everybody wants to grow. And as you know, and help the audience, a lot of great companies and many great companies start in recessions.
Mm-hmm.
So, when you think about getting through this, and I have no question we will get through it. I do not know what the other side looks like, but we will get through it. That's just what history says. When do CEOs get a little bit more aggressive, right? Is it a 3-month wait and see? Is it 6 months? Do you have any feel for when a CEO goes, that's enough, scarcity mindset, let's drop the hammer?
I always think as a CEO, if you're seeing 2 consecutive months, not even 3, 2 consecutive months of things not going in the right direction,
Okay.
your anxiety goes through the roof, right? Because
Okay.
everything is reported quarterly.
Yep.
And that's actually one of the problems. Is the question is always, is this a short-term thing because the long term is going to be better?
Mm-hmm.
Or is it just always going to be this way? And I think that's a problem with quarterly earnings, and why a lot of companies choose to stay private for long.
Yeah. Yep.
Is that you're not constantly trying to every quarter beat the one before. You can say, hey, I'm innovating, I'm building something bigger and better, and it's AI enabled and this and that. So don't worry, it's coming and we're going to innovate. I think that's why you see a lot of public companies, it's hard for them to innovate because finance is running the show.
Yeah.
But I still think from my perspective, one bad month, it's always why, and let's go ahead and reflect on it.
Okay.
2 bad months is, shoot, this is not good for our business. And what are we going to do in this situation?
Okay.
I see with it, you start taking action. The first one saying what happened, what went wrong. And the second month, you try to fix it. But if you can't fix it after that, you've got to take action right away. And again, it depends on what it is. If it's a dying product that you're like, well, we wanted to get rid of that anyway, and if maybe it's 10% of our revenue, but it's not the right product, maybe that's okay. You can go for the future and build something else. But if this is like your main product and you're seeing churn multiple months just continue to increase or whatever it may be, that's really where you start worrying and say, we need a bigger war room, and we definitely need the whole company focused around this.
All right, so let's play that out. So I love that advice. I think a lot of CEOs are about to go run into a couple of tough months. So again, war room, protect, learn, grow, get it. But let's paint the vision of opportunity. So let's say you have those 2 months. Let's say the CEO makes some adjustments. How many months do they have to see that it's working or not getting worse for them to make moves, because that's really where I want to get to this. At the end of any recession or in recession, there is always opportunity. I would argue most people miss it because they're afraid. I have seen most CEOs, they are on the, I don't know, riskier side, just growth mindset, right? That's when you're a CEO, that's what you want, right? Let the bean accountants, which I was one, be the downside. To me, the CFO is always the wet blanket. The CEO is always the visionary. Let's go forward. My words, not yours. Not to,
Yeah.
partake on the bean counters. But when does the CFO go, that's enough scarcity mindset? We're going to take a shot. We're going to buy a competitor. We're going to go a new market. We're going to launch that new product. When do people in a recession go, enough is enough being afraid? I want to make a move and see if we can get some escape velocity.
Well, I think that's the problem with CFOs is that most of them are in a very reactionary versus growth mindset. The best that I have worked with, and actually one of our finance advisors who I meet with every week, is actually never, well, he does focus on expenses to make sure those are in line. And he will call something out 6 months before I call it out to say this is a problem. And I'm like, yeah, you're right. That is a problem.
Damn it.
But also focusing on that revenue line, because I've always said this, revenue solves everything.
Yes.
If you have revenue, it solves everything. But I don't think there's enough CFOs like that, because the easiest thing to do is to look at expenses, and it's the easiest thing to manage. And so really, when you look at your exec team and how to think about that, and the bean counters, I don't think it should be the bean counters in the room. I think someone who does count beans, but also can be more strategic, that's kind of the definition of what a CFO should be.
Yeah, I couldn't agree more. Again, I've seen, I remember probably the best CFO I worked for is a guy named Dave Conti. I believe, I always call him Conti. I think his first name was Dave, out at Splunk. He was amazing looking at that. He could be both the traditional bean counter and the kind of typical Valley, executive leaning forward. He could play both sides, which I had never seen in a CFO. When I was accountant, all of us were wet blankets, right? We were just beaten into submission. And again, that was at a hardware company. Right. It was, quantum disk drive. So very much a hardware company back in the day. So lots of supply chain, just in time, inventory management, working. It was a mess. But at the end of the day, I think CFOs and CEOs and executive teams are in it. I don't see a lot of good short-term options. I think all the CEOs that are in my kind of world are kind of in it right now, kind of to your point, in war rooms. It will pass, and it will be time to go get aggressive, but it's certainly uncomfortable right now. Dana, any closing thoughts, and where can people find you?
Just want to remind you, don't run out of cash. And if you work at a hardware company, I would be looking at your cash flow statement. And if it's not public, I would be asking, what is our burn?
Yes.
And how much money do we burn every month? And then how much cash do we have in the bank?
I love that. I love that. Folks, don't forget, go to hemlane.com. You can mention ORaaT, get a little discount. They have a free version. Also, don't sleep on their resources tab. If you're a new investor just getting started and you want to know the rules of the land in your area, if you are not going to hemlane.com/resources, you are missing out. Dana, thank you so much.
Thanks for having me.